develop a plan. I don't care if insurance is involved or not, but you've got to communicate with your family what your wishes are. Who's going to provide the care? Where's care going to be provided? How's it going to get paid for? It's just a roadmap that tells your family what your wishes are.
Welcome to Retirement Revealed. I'm your host, Jeremy Keil, and we're here to turn your retirement savings into retirement income. Today, we're talking with Mike Smith about long-term care insurance. Mike, welcome to the show.
Happy to be here, Jeremy.
Yeah, and I got to say, actually, welcome back to the show. You were on the show a few years back talking about long-term care insurance, life insurance. Tell me a little bit about yourself and how it is that you've got this kind of great breadth of knowledge on all the different types of the insurances that are out there.
Sure. I own what's called a brokerage general agency. So we do life insurance, disability, long-term care, and some annuities. And so I help financial advisors help their clients when it comes to insurance. So if your client or one of your clients is looking for an insurance solution, whether it's reviewing what they already have or looking to obtain some insurance, I'm a resource that a lot of financial planners go to help shop the market and help their clients find what's in their best interest for different types of insurance.
Yeah, and best interest is a term that gets used a lot more and more. And I think a lot of times the way that we're used to getting insurance is more through what's called like a career agency type of situation. Do you mind just like sharing a little bit about that? So we just have a kind of an idea of the difference between working with an independent agent that uses a broker general agency versus one that may be through what's known as a captive insurance agent system.
Sure. The industry used to be more of a captive insurance industry. You used to work for one insurance company, and so the client would get quotes from just that one insurance company, and that's it from that particular agent. And then, probably, gosh, maybe about 40 years ago or so, the more independent side started to pop up, where you could have an insurance representative represent different insurance companies and be able to shop those different companies and find what's in the client's best interest. So I am more of the independent model that has grown dramatically since in the last 40 years. More and more career distribution companies have gone to the wayside. They're still out there. There's a big quiet one downtown Milwaukee. But if you really want to, for a lot of clients, if they really want to be able to see what's in their best interest, they find an independent advisor and who can shop the market and find the best solutions.
Yeah, I'm in Wisconsin. You're in Wisconsin. You referenced in Milwaukee, Northwestern Mutual has a headquarters. Also out of Wisconsin is Thrivent Financial. There's some bigger ones that are out there like New York Life, Mass Mutual. And I know that even some of their what's known as captive insurance agents, they've got a more of a flavoring, more of an ability to go outside and find different options. And I think that's important because this different options, there's a lot of insurance companies out there. I've known you for 20 years, Mike, and you've shared with me throughout the whole time that, hey, there's more out there than just what you might find in one particular company. And that's why I wanted to bring you on, because you get a flavor of kind of everything that's out there. And we're going to talk about long-term care insurance specifically. But tell me, especially with long-term care insurance, how has that changed just in the last 20 years since I've known you?
Boy, back when long-term care insurance first came out, it was pretty much covering only nursing homes. So if someone had to go to a nursing home, then their insurance would kick in. It wouldn't do anything for home health care or assisted living. And then as times have changed, policies now add home health care, assisted living, and nursing home care. And it used to be that the only way you could get that is through a traditional long-term care insurance policy. That still is possible today. And the policies that are out today are much better than they were 15, 20 years ago. But in addition to traditional long-term care insurance, there's now hybrids where you can have life insurance with a long-term care rider or an annuity with long-term care features. And so there are pluses and minuses to each of those, which I'm sure we're going to cover today. But that's what's really changed is there's a wide variety of different ways you can have insurance company money help pay for long-term care expenses.
Yeah, and these different types, I think a lot of people don't realize there's different types of long-term care insurance, and there different companies focus on those different types. So that's why it's helpful to have kind of access to all the different insurance companies that might be out there. I like how you mentioned pluses and minuses. I think I'm gonna throw that into our agenda here. That I was going to have you just describe each one, but I think I'll have you describe it and then go through the pluses and minuses for each one as well too. So that's
Sure.
I'll throw a surprise at you, but I think it'll be valuable for for all of us. And we're talking long-term care insurance, but there's a certain type of long-term care. Someone just a client just asked me about that, and I said you should do a podcast episode about this. I said I actually have one planned, and so that'll be my first question here for you. But this might be a surprise to everyone. But one part of long-term care insurance might be short-term care insurance. Tell me a little bit about that, Mike, and why someone might be interested or looking at what's known as short-term care.
Short-term care insurance is a viable option in certain circumstances, and that could be a wide variety of reasons, which we'll get into in a second here. But short-term care insurance typically covers 1 year of care at home and 1 year of care in a facility, like assisted living or a nursing home. And it doesn't have to be back to back. So if someone needs care, and they receive care at home for 2 or 3 years, the first year would be heavily subsidized by the insurance company. And then as their health deteriorates and they have to go to a facility such as assisted living or a nursing home, there's an additional year's worth of subsidizing from the insurance policy. So it's a bit of a Band-Aid, but it's not bad. It's not a bad Band-Aid at all. And why would somebody consider that? For a couple different reasons. One, they're kind of old and kind of should have gotten long-term care insurance back when they were in their 60s, but now here they are in their 70s or 80s, and long-term care insurance is too expensive. A short-term care policy is not a bad solution. Or they've got some health issues. So maybe they're not healthy enough to qualify for traditional or a hybrid long-term care policy. The underwriting for a short-term care policy is a lot easier, and it's a way where they can get some coverage. Something's better than nothing. I like short-term care. We recommend it many times, but it's often because somebody has not been able to qualify for traditional long-term care insurance, or it's too old, or they're too old, or it's too expensive for them. It's a Band-Aid, but it's not a bad Band-Aid at all.
Yeah, it is interesting. I'm hearing you speak. You're talking to me more and more, I think, into considering this more and more, because I think just the standard in the industry, or an individual who's trying to plan out their retirement thinks more of the long-term care. But I often suggest considering long-term care insurance just as a kickstart. It's not there anymore with a promise really to say we'll cover everything. I think long-term care insurance is there as a kickstart. What I like to say is when you go to the doctor, and the doctor says you need some care, and then you tell your kids, and they're like, yeah, Dad, you need some care. If you have an insurance company footing some of the bill, kind of kick-starting it, you'll actually maybe go and get the care that you need in that short-term care. That's kind of designed for that. That's designed for that kickstart.
And your kickstart's a good point. Let's say you've got your clients that say you do your needs analysis with them. You're helping them try to figure out if they even need long-term care insurance. So maybe they've got enough assets or they've got enough wealth that they really don't need long-term care insurance. They could self-pay. Well, what short-term care insurance can do is buy time. So it's like, okay, your client all of a sudden has that stroke and now they need care. And now you have to liquidate some of their assets to help provide the dollars to pay for their care. The short-term care policy can help do that. So instead of liquidating all their assets or part of their assets, you and your client have more time to review the situation, say, okay, we know we're going to liquidate some funds to help pay for your care, but we want to do so in the most tax efficient way possible, looking at possible income taxes and capital gains. If you can spread that out over, say, 2 years, because the first year is heavily subsidized by the short-term care insurance policy, that's a very solid plan.
Okay, yeah. So we've got a good overview. Let's break it down then. Tell me some of the pluses of short-term care, and tell me some of the minuses of short-term care.
The pluses are that it provides care for at home and assisted living and nursing home. It's only a year each, but the nice thing for the insurance companies, they know exactly what their expenditures are going to be, because when you apply for and obtain a short-term care policy, you're getting a known amount of benefit dollars that are going to come to you. Traditional long-term care insurance often doesn't have that. Sometimes it's an unknown amount, so therefore the price is higher. So because an insurance company and the client will know exactly what they're going to get from the insurance company, pricing is pretty affordable and is less expensive than long-term care insurance. The downside, the one more upside is many of the policies have what's called the elimination period, and it's a 0-day elimination period for home health care. So if someone needs care suddenly at home, the policy can kick in basically day one and provide benefits, whereas you don't have to wait 90 days like a lot of long-term care policies. So another area of short-term care works really well are single individuals. You've got mom who lives here in Wisconsin, but her two kids are in different states. She's living on her own because she's a widow or divorced or something, and she's sitting here in her 70s or 80s. And, it's difficult for the kids to help provide the care or come home and check on her and help on things. A short-term care policy, when it allows to kick in right away, that's a really nice feature and gives a lot of peace of mind. So that's another plus on that. A negative, if you need care longer than 2 years, and I don't have that crystal ball. Few people do. So if somebody needs care longer than 2 years, which is the norm, most long-term care claims last 4 to 4.5 years. At least you've got 2 years covered. Again, like I said a couple times now, it's a Band-Aid, but it's not a bad Band-Aid at all.
Yeah, that's a good way to view it there, what it does for you. Now, let's start looking at more of the long-term care parts of it, and let's start with the traditional. And tell me even why do you call this traditional long-term care as opposed to maybe something that's untraditional?
Well, I'll break it down to two methods here. There's traditional long-term care and there's hybrids, and we'll go into each, but let's talk about traditional long-term care first. That is long-term care insurance only. There's no extra feature like life insurance or annuity or anything like that tied to it. Traditional long-term care insurance is always going to give you the best bang for your buck, meaning the most amount of benefits for the least amount of premium. Okay. So, and how you qualify for a claim for all of these, I'm going to explain the claim process for traditional and the hybrids. Is if your doctor says you have a cognitive impairment like Alzheimer's or dementia and you're no longer safe by yourself, that's one of the ways you can get a successful claim for long-term care insurance. Another is if you can't do two of the activities of daily living without somebody helping you. And those activities of daily living are everything you've already done this morning. Okay. Transferring, so getting out of bed or in and out of a chair, going to the bathroom and relieving yourself. A third way is keeping yourself clean if you need help with taking a bath or a shower. A fourth way is getting dressed if you need help somebody getting you dressed. A fifth way is if you need help feeding yourself or eating. And the last is continence or bladder control if you have problems with that. If you need help with two of those, that's how you qualify for a successful long-term care insurance claim. Now, that's the same for traditional and the hybrids. So now just focus on the traditional a little bit. The positives there are you get the most bang for your buck, meaning the most amount of benefit for the least amount of premium, like I mentioned before. But one of the downsides is, what if I die without ever using it? There's no return of premium. It's just like auto insurance or homeowners insurance. You've paid all these years for premiums and you were fortunate enough never to have to go on claim. There's no money that comes back to the family or back to the estate to reimburse all those premiums. That's one of the negative downsides. The other downside has been the history of rate increases. So in the past, older policies, people who bought policies in the 90s and 2000s, they have been getting hit with premium increases. So someone might be saying, okay, when I bought my long-term care insurance, the premium was the same for a long time, but now they're asking me to pay more. They're not picking on the individual consumer. They're picking on everybody in the state who's got that same policy. So if they're raising rates, they're not raising the rates because someone's got a health issue. They're raising rates for everybody across the board. The newer policies that have been issued since 2013, we have not seen the rate increases happen yet. I'll come back to that in a second. But if you've got if you or your clients or your listeners have an older policy, you might be getting hit with a rate increase. There are some steps to take to help keep that rate more level, but the consumer is usually giving up some kind of benefit to do that. So that's one of the negatives about traditional long-term care insurance is they could raise the rates. Now, I said before, newer policies, I have not seen the rate increases. That was true until just very recently. One of the major insurance companies just announced their intention to raise premiums on people who have their insurance and the policies are newer than 2013. That's a bit of a concern to me because this is a company that has promised for a long time, we don't plan on increasing rates. We don't plan on doing this. And now all of a sudden they've just come out with a memo that they may try to do this.
Mm. Yeah, one of the big things you heard maybe starting 10 years ago, 15 years ago is that the policies you bought 20 and 30 years ago, those rates were going up. And that made a lot of sense. They were premiums that were built on interest around 5, 6, 7%. Interest rates go to zero. the insurance company just doesn't have any interest around to help pay the claims that are out there, so they were forced to raise those premiums for the existing policies. And you would think then, and I thought as well too, okay, 2010, 2012, 2015, these companies that were selling the long-term care insurance at that time were basing it on that much lower interest rate. So this fear that rate increases might happen if you get the traditional long-term care seems like maybe it didn't go away, which is one thing. And tell me how you feel about this advice I often give to people, is that if you are going the traditional long-term care type of policy, my encouragement is to use what's called a mutual company instead of having a stockholder where the company is raising the rates to make sure there's money there to pay out and dividends for the shareholders. They will raise the rates if they need to, but the actual owners of the contract, the person with the contract, is the owner, mutual owner of the company. And so, yes, they may raise the rates, but they're not having to raise the rates to also have a return to shareholders. And if
Sure.
they're raising rates on their owners, they're trying to keep that to its minimum, because who wants to raise rates for the ownership, of the company?
Well, the company that's now raising the rates is a mutual company.
Oh,
So,
geez, okay.
yeah. But here's one of the
Well,
main
hopefully it's as
reasons.
low as possible then. That's
Yeah,
been my theory.
right. But here's where one of the main reasons is because of claim history.
Hmm.
People bought their insurance and they're going on claim, and the company's paying its claims. So that's a good thing. People who have got long-term care insurance, these companies make their claim payments. And their claim history, their claim is higher than they expected, and that's one of the
Hmm.
reasons why they're talking about raising premiums on existing policyholders.
Yeah, it's a tough one because you might be scared of the rates going up because people are using it more, and that's kind of proving the need for it because people are using it more, and you might have that need
Right.
down the road on there. There's some specific terms when it comes to long-term care insurance, and I thought it'd be helpful just for us to go through, get a good definition of those. I've got 6 of them in front of me, and then I'll find out if I maybe missed one.
Okay.
But I'm just going to ask you these terms that you hear with long-term care insurance, you really don't hear so much anywhere else. So that'd be helpful for us to get a definition from you. So tell me what this phrase means. What is an elimination period?
Think of that as the deductible. The elimination period, most of the time it's 90 days. That seems to be the sweet spot between different companies and their pricing. So if you need long-term care services and you file a claim, the first 90 days or the elimination period is on your own. And then after that, the policy starts to kick in and pays benefits. So
Yeah,
think of that as
excellent.
a deductible.
Yeah, it's just a different, like a time deductible in a way.
Mhm.
Yeah.
Exactly.
How about monthly benefit? How's that come in?
When you buy any form of long-term care insurance, what you're doing is you're buying a pool or a bucket of money from of the insurance company's money. And they're saying, here's your big pool of money, and you're going to pull some money out to help offset your care, but we're going to give it to you in a monthly benefit, so monthly increments. So a monthly benefit or a benefit period is how long your benefit period is.
Yeah. And then, so you've got here that monthly benefits, kind of like the dollar amount. And then the benefit period, that's the other one. It's like how long. So it's almost like here's that box of money, and you want to see how much it is and how long it's going to be. So monthly benefit and benefit period
So
on there.
your policy might have a total benefit, say $300,000, but the monthly benefit will be $6,000. Using that as an example,
Hmm.
so every you receive $6,000 a month every single month until the $300,000 is used up.
Yep, you got it. And then they would have been that benefit period. Sometimes I see like a benefit multiplier. Yeah, it would have been 50 months in that example right there.
Correct.
Now, a lot of people are concerned about the cost of care is going up. Tell me about the inflation riders that are out there that can help with that.
So let's say you sign up for a $6,000 monthly benefit for a long-term care policy. That's not too bad. Okay. One of the things you have to realize is, you want your long-term care insurance to cover everything or put a dent in the bill. So in today's dollars, $6,000 a month will put a really nice dent in the bill for home health care. Might cover all of it. Might cover all of a home health assisted living experience. But a nursing home might be a little bit less than that. So a nursing home's like, say, $10,000 a month, and you've got 6,000 covered by the insurance. Um, that's where you have to try to figure out, okay, do I want to put an inflation rider on that 6,000? So as the cost of care goes up, my $6,000 monthly benefit will go up over time as well. And you do that with an inflation rider. Typical ones I've seen is a 3% inflation rider, and I've also seen a 5% inflation rider. An inflation rider is what makes long-term care insurance expensive. That's what you have to try to remember, is that if do I want to sign up for a $6,000 with inflation, or should I sign up for something a little bit bigger like $9,000 a month without inflation? Depending upon your age, it might make more sense to do 9,000 without inflation than it is 6,000 with, because that inflation rider is so expensive.
Yeah, that's a good tip for what to be looking for when you're designing a policy. And that's something I know that
Mhm.
you and your team are doing is, okay, based on what the client needs, how do we design the policy? Tell me a little bit about what's called shared care, right? There's two of us, and maybe we use it, maybe we don't, but tell me how we can go through that with shared care.
A shared care rider is one of the best riders available. And I always suggest that when I'm talking to a couple about long term care insurance. Obviously, you have to have two people on a policy. So let's say, Jeremy, you and your wife, you've got a long term care policy and you've signed up for a total benefit of $300,000. Okay. That benefit period equals 300,000. And you go on claim and you use up all $300,000 of the insurance company money, and you still need care. What the shared care rider does is it allows you to tap into your wife's pool of $300,000. And so if you still need care, you're going to be pulling out 6,000 from your wife's $300,000 pool of money. Yes, you're reducing what's available for her, but you're on claim right now. You know you need the money. You know that you're going to be getting the insurance company the money to help offset your claim. A share care rider is a very cost-effective way to have some flexibility into a contract that allows for a husband and wife to receive bigger than their own pool of money. They can tap into their spouses. It's a great rider, and I recommend it almost every time.
Yeah, I can understand that. I've heard things like you've got a 70% chance of needing long-term care. So there's two of you. One of you will need it, but you just don't know who. Like I've heard phrases like that, and I think the shared care rider might be what helps with that situation. Yeah.
Correct. It really helps.
Yeah, you've mentioned home health care, and I've seen this thing called, and we said earlier, elimination period, but I've seen a 0 day elimination period for home health care. Why would somebody consider that?
Basically, just so they could start to receive benefits quicker if they need care at home. Most insurance companies have, especially traditional long-term care insurance, have that option where you can have a 0 day elimination period from home health care, but maybe a longer elimination period for a facility. It's all a matter of personal choice. If someone doesn't have a lot of resources, they might want to have a 0 day elimination period. But the shorter the elimination periods, the higher the premium. So you have to realize that if you want something more of a Cadillac plan, expect to pay something like Cadillac prices.
Yeah, right on. Well, I'm going to ask you about the different types that are non-traditional, the hybrid type of policies. But before that, were there any phrases, any terminology that I might have missed?
I think one of the most important things when it comes to traditional long-term care insurance is plan design. Like I mentioned before, do you want the long-term care insurance to cover everything or put a dent in the bill? And if you're going out and taking a look, and if your clients are interested in long-term care insurance, get a wide variety of different plan designs and from different insurance companies. That's where you're really going to get a good education and say, does traditional long-term care insurance make sense for me?
Yeah, I like that idea. Now, I'm going to ask you about the hybrid kind that I think hybrid long-term care insurance less people are aware of, and then we'll get into the one I think most people are thinking of when they think of hybrid. But tell me about the annuity version of a hybrid long-term care insurance. How would that work?
Sure. There was something called the Pension Protection Act that was passed like in 2010. So this isn't new, but it's still kind of new to a lot of people. And what it basically allows for is money to come out of annuities without having to pay taxes on the gain to help offset long term care costs. But you have to have the certain type of an annuity to do that. It's got to be a Pension Protection Act friendly annuity. Okay. What the heck does that mean? Well, what they do is they actually put a long term care rider onto the annuity, which allows for the doubling or even tripling of the annuity value. So let's say you've got an annuity worth $100,000 and your gain is 25,000. So it started at 75,000. It's now grown to 100,000. If you just keep that as an annuity and you say, okay, now I need to take money out of that for my care, you have to pay tax on the $25,000 gain first, and then as you take your money out. If you put it into an annuity hybrid with long-term care, now that 100,000 can be worth 300,000 for long-term care purposes. And when it comes time to take the money out because you go on claim, you don't pay tax on the gain either. So if your clients, or you've got somebody who's got an annuity that's really not being used for retirement purposes, does it make some sense to take a look and say, all right, let's take this annuity and put it with a long-term care rider. So that's my emergency fund. I'm 75, I'm 83 years old, whatever. I've got this annuity that's just kind of sitting there. Why don't I play some defense and have it with a long-term care rider? So if I do need money for long-term care, I can take it from this annuity tax-free, as opposed to liquidating some other assets and paying tax.
Yeah, I've seen a lot of annuities that have that interest built up, and the person says, "Well, I don't want to touch it because I know that the first money comes out will be taxable." And so, if they happen to have that situation and they have a need and desire for long-term care, maybe you just marry it together and say, "Put this together to kill two birds with one stone." Tell me a bit about the pluses and minuses then of an annuity long-term care hybrid.
The plus is that you are leveraging the dollar amount of the value of the annuity. So you're taking that 100,000 and you're turning it into 2 or 300,000, or even lifetime benefits. You can have this provide benefits for the rest of your life, and it's a very tax favorable way to do that. That's some of the biggest pluses out there. Another plus is some companies allow you to put your spouse on there. So maybe the annuity is in the husband's name, and if he just does something for himself, what does his wife have for long-term care? You can go to one of the companies that has long-term care annuity that includes the spouse on there. So one annuity can help provide dollars for both spouses, and it's still leveraging. What makes some sense has to be analyzed for individual circumstances, but it's something worth exploring. A negative is that these are not designed for growth. A lot of people who have annuities, they're looking for growth. They're chasing that interest rate, or they're chasing that return, and they're just trying to have that account continue to grow and grow and grow. These are not designed for that. So if you have an annuity that you know you're going to want to take money on to supplement retirement income, these annuities with long-term care riders are not the way to go. But if you're saying, I've got this annuity, I really don't need the money, I don't anticipate needing the money in case it's an emergency, that's where these annuities with long-term care can make a lot of sense.
Yeah, it's of course, you are paying for the long-term care portion of it, and you are with that company and whatever interest rate that they are providing, and they might not feel a need to give you the absolute top dollar interest rate, but it's you're getting a combo. That's what it is. It's a combo. So you're getting a little bit of both, right?
Yep. Yep.
Yep.
And it's a great solution for people who have kind of lazy money, that they're just not using the money and for income purposes.
Mm-hmm. Yeah.
And it's the other thing is there's no rate increases. So
Oh, there you
people can
go.
put their money in there one time, they just transfer funds over, tax-free doing that. And if they never need long-term care, it's paid. If they never need long-term care, it can be paid out to their beneficiaries. If they do need long-term care, the dollars are there, and it's a leverage, so it's a higher dollar amount than what the account started with.
Yeah, it's amazing. I think a lot of times people don't realize the world of possibilities when it comes to long-term care insurance, and just finding it's not almost even like, do you want it, like a yes or no. It's what type of it do you want? So you got kind of different things to consider, and that's
Yeah.
what I think everyone needs: a long-term care plan. That's what I tell people. They ask me, I'm often asked, should I have long-term care insurance? And I say, you need to have a long-term care plan. Everyone should have a plan for it. Consider how are you going to pay for the long-term care? Where do you want that long-term care to be provided to you? Who do you want to have providing that long-term care? But whether you help pay for that through an insurance situation is a kind of different story. It's the next thing to keep in mind as part of it.
You're bringing up a huge point that everybody who's watching and listening should take a look at. Develop a plan. I don't care if insurance is involved or not, but you've got to communicate with your family what your wishes are. You should have a power of attorney for healthcare, power of attorney for finances, and I know you do a great job in that. But you should also have a written plan telling your family what you want to have happen should that stroke hit unexpectedly, or you need long-term care services. who's going to provide the care? Where's care going to be provided? How's it going to get paid for? I know, Jeremy, you and your team do a great job in helping your clients figure that out. But that's the number one takeaway is get a written plan. It doesn't have to be a legal document. It's just a roadmap that tells your family what your wishes are.
Yeah, right on. Well, there's one more version that's left out there. And I think it's the one that most people are interested recently. At least that's what I hear from. So tell me about this idea about a life insurance and long-term care insurance combo plan. How does that look?
Sure, and that's using permanent life insurance. So it's universal life insurance or whole life or variable universal life. What people are doing here is they've got this life insurance. They've had it for a long time, but it only provides life insurance. So when you pass away, it's there for your family, which is great. Now you can put a rider on a long-term care life insurance policy. It's a long-term care rider. So if you need access to the death benefit for long-term care expenses to help offset home health care, assisted living, and nursing home, you can have access to the death benefit tax-free to help pay for your care. So it's really just an advance of the death benefit. And a lot of these companies have it where the rider is minimal cost, and some of it where it's free. I like the ones where it's a minimal cost because it's going to tell you exactly how much you're going to receive if you need long-term care services. Again, home health care, assisted living, and nursing home. So a $300,000 policy might kick out $6,000 a month for 50 months. So every time you take money out of the death benefit for long-term care purposes, you're lowering the amount of death benefit still there, but you're getting the money while you're alive, and you've got this big expensive bill each month. Have the life insurance pay the bill on your behalf while you're still alive. These are becoming very, very popular.
Yeah, I think that's what people are saying to me, at least, is that I want to make sure something happens, that I pay all this money. And unlike the traditional long term care, where if I don't go on and claim, which is kind of the hope that you don't get to that situation, if I don't go on and claim, if I don't need the insurance part in the traditional world, it's like the car insurance, like you said, no car accident, there's no money that comes back to you. No long term care needed, no money that comes back to you. But with the life long term care insurance combo, it's kind of it's an either or, which a lot of times people tell me, or they talk about it almost as if it's like a free ride. Like, no, you're getting two things, right? You're paying for the two things. It's a combo, so it's probably not as expensive as if you bought them two separately. But there is an extra cost, like you mentioned.
Oh, yeah. Like I said at the beginning of the podcast here, traditional long-term care insurance gives you the best bang for your buck, the most amount of benefit for the least amount of money. But that does not return anything if you never go on claim. The life insurance and the annuities with long-term care will return something if you never go on claim or if you don't use all your benefit up. But there is definitely a higher cost. If you're trying to say, all right, let's compare traditional long-term care insurance. The husband wants $300,000 worth of care. She wants $300,000 of care, and compare that to life insurance for 300,000 that could be used for care. It's much more expensive for the life insurance as the traditional, but you know you're going to get something back. Now, where it does make a lot of sense for clients is that they have existing life insurance with cash value in it already. And maybe it makes some sense to transfer the cash value from this insurance company that does not have a long-term care rider to a life insurance policy with a long-term care rider. We've seen it in many circumstances that people have come out with either the same amount of insurance or even more insurance with less premium, and there's a long-term care rider to it. So if you've got I guess the takeaway on this aspect is if you've got some traditional life insurance with cash value to it, have your advisor take a look at the annual statement and analyze whether it makes some sense to maybe switch it to something with a long-term care rider, life insurance with a long-term care rider. It might be in your best interest.
Yeah, it's almost like you review your investments at least every year. You ought to review your insurances and see what do I want, what's it doing for me, and if there's a gap between what's it doing for me and what you want, then there's possibilities to go get to what you want.
Things have changed dramatically. This thing here used to be just a phone. Okay.
Yep.
Now it does a whole bunch of other things besides making a phone call. Life insurance and annuities really have had a lot of innovation as well. It's not just life insurance anymore. There's lots of different things you can do with the life insurance and ways you can have access to the insurance amount without having to pass away. And that's for long-term care expenses. There's even things where if you get sick, like a heart attack or stroke, you can have access to the life insurance for those purposes as well. So If you're sitting here with an older policy, maybe it makes some sense to say, hey, do I want to take a look at something that's a little bit newer and more innovation?
Yeah, it's worth looking at and considering. Now, let's finish up. Let's tie it off with with a bow here of life and long term care insurance. Tell me what the pluses are. Tell me what the minuses are.
Well, the minuses I mentioned a little bit already are that it's more expensive than traditional, but that doesn't mean you don't look at it. It's still worth exploring to see if that makes some sense. That's probably the biggest negative. The positives are many. Tax-free dollars, it's advance of the death benefit. You can put a husband and wife on one policy with a couple of circumstances. A lot more flexibility. So if you never need long-term care, there's a death benefit paid out to a spouse or to the family. It's a matter of just what I always suggest. If somebody says, hey, I'm interested in long-term care insurance, can you give me a help, Mike? I'm educating them in all the different ways. We'll start with traditional long-term care insurance. Here are the pluses and minuses. We'll pivot to life insurance, a long-term care rider. We'll pivot to the annuity with long-term care and some of the other hybrids that are out there. And I give them a quick 20-minute education on each of those, total 20 minutes. And then we narrow down and say, okay, which does this fit your category? Is this what your wants and needs are? Let's make some suggestions here. But it's not just going in and just having somebody just say, you want long-term care? Here's one quote and that's it. I try to educate them on all the different types of long-term care insurance and then narrow down with them and their financial advisor quite often what's best for them.
Yeah, and that education piece, a lot of it's on your website. I'm going to have links to that in the show notes because you have information about the different types of the long-term
Mm-hmm.
care, information on the short-term care. So you can go check out Mike's website, which is cpshorizon.com. But I'll put links to the direct parts of long-term care and the short-term care part of it. I've got one more question for you, Mike. But before that, tell us what's the best way to reach out to you?
A couple different ways here. You can go to my website, cpshorizon.com. I have no problem if somebody wants to email me. It's mike at cpshorizon.com. That's C as in Charlie, P as in Pumpkin, S as in Samantha, horizon with an H.com. Or give a call, 414-427-8660.
All right. We'll have all that links in the show notes. If you're driving, you can go right to the website, get that info. Well, I've got the final question for you, Mike. Tell us something about yourself that few people know. And remember, this podcast is rated clean.
Okay. A couple of things. Well, one of the things that's kind of fun that I get to do is I travel a lot with my wife, and we went to an island called Roatan a couple of years ago, and we're going to go there again in beginning of 2026. Uh, Roatan's an island off of Honduras, and it's fantastic beaches, beautiful water, second largest natural reef in the world. My wife and I are scuba divers, so we'll be doing some scuba diving. We've done some diving down there already. So if that was a great little sneaky getaway, was to an island that nobody's even heard of before called Roatan.
That sounds like a lot of fun. I've never heard of Roatan. Apparently, next time you show up, there'll be a lot more people there because you're spreading the word.
It's a hidden gem. There's no question on that.
Yeah, that's awesome. Good. Well, thanks for coming on the show, telling us all about the different types of long-term care insurance, including short-term care insurance. That was a big help.
Excellent. Happy to help out.
Yeah, thank you, Mike, and thank you for listening to the Retirement Revealed podcast. We believe if you know more about your money, you will feel better about your money, and you will make better money decisions. Hi, I'm Jeremy Keil with the Keil Financial Partners. If you'd like to see how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.